Mr. Buffett, many in the academic community call you lucky or a statistical outlier. Mr. Munger, I'm not sure what they call you.
Well, you're free to speculate on what they call him.
I know you don't like to forecast the equity markets, but maybe you would dare to forecast the evolution of the debate between proponents of the efficient market theory and value investors. Do you think there will ever be a reconciliation? And I'm talking especially about what's taught at the business schools. And as an addendum, are your designated successors, are they outliers as well?
Well, we like to think they are, and they may be more outliers than we are. The market is generally, to me, it's almost self-evident if you've been around markets for any length of time that the market is generally fairly efficient. It's fairly efficient as pricing between asset classes. It's fairly efficient in terms of evaluating specific businesses. But being fairly efficient does not suffice to support an efficient market theory approach to investing or to all of the shoots that have come off of that in the academic world. So if you'd believed in efficient market theory and been taught that and adopted it for your own 20 or 30 years ago or 10 years ago, I think it probably hit its peak about 20 years ago. It would have been a terrible, terrible mistake. It would have been like learning the earth is flat. You'd have had the wrong start in life. Now, it became terribly popular in the academic world. It almost became a required belief in order to hold a position. It was what was taught in all the advanced courses, and a mathematical theory that involved other investment questions was built around it, so that if you went to the center of it and destroyed that part of it, it really meant that people who'd spent years and years and years getting PhDs found their whole world crashing around them. I would say that it's been discredited in a fairly significant way over the last decade or two. I mean, you don't hear people talking the same way about it as you did 15 or 20 years ago. But the market generally is fairly efficient in most ways. I mean, it's hard to find securities that are inefficiently priced. There are times when it's relatively easy, but right now, for example, it's difficult. I don't know exactly how much it's wholly writ still in business schools. I certainly get the impression as I go around talking to business schools that it is far less regarded as sort of unquestioned dogma that like it was 15 or 20 years ago. The University of Florida now has some courses in valuing businesses. University of Missouri is putting in one. I think the high priests of efficient market theory are probably not in the same demand for speaking engagements and seminars and all of that as they were a decade or two ago. It's hard, though, it's very interesting. It's hard to dislodge a belief that becomes the dogma of a finance department. It's so challenging to them, and they have to, at age 30 or 40, to go back and say what I've learned up to this point and what I've been teaching students and all of that is silly. That doesn't come easy to people. Charlie?
Well, Max Planck, the great physicist, said that even in physics, the old guard really didn't accept the new ideas. The new ideas prevail in due course because the old guard fades away clinging to the asset entities of the past. And that's what's happened to the hard form efficient market theorists. They're an embarrassment to the scene, and they will soon be gone. On the people who think the market is reasonably efficient or roughly efficient, of course, are absolutely correct, and that will stay with us for the long pull.
Thinking it's roughly efficient, though, does nothing for you in academia. You can't build anything around it. I mean, what people want are what they call elegant theories, and it doesn't work. What investment is about is valuing businesses. I mean, that is all there is to investment. You sit around and you try to figure out what a business is worth, and if it's selling below that figure, you buy it. That, to my, you can't find a course virtually in the country on how to value businesses. You can find all kinds of courses on how to compute beta or whatever it may be, because that's something the instructor knows how to do, but he doesn't know how to value a business. So the important subject doesn't get taught, and it's tough to teach. I think Ben Graham did a good job of teaching it at Columbia, and I was very fortunate to run into him many decades ago. But if you take the average PhD in finance and ask him to value a business, he's got a problem. And if he can't value it, I don't know how he can invest in it. So therefore, it's much easier to take up efficient market theory and say it doesn't make any difference because everybody knows everything about it anyway. And there's no sense in trying to think about valuing businesses. That the market's efficient, it's valued them all perfectly. About on the second day in that course. I mean, you walk in, you say, everything's valued perfectly, and class dismissed. So it puzzles me, but I encourage you to look for the inefficiently priced. Zone 3. Berkshire, incidentally, was inefficiently priced for a long time. And it wasn't on the radar screen. If you'd asked an academic how to value it, they wouldn't have known what to look at exactly. Yep.
My name is Esther Wilson. I live in South Sioux City, Nebraska. My husband and I will have some new money in the early 80s of our lifehood. We have a daughter 50 years old who will inherit anything we have. My question is I also have a 4% interest on a mutual fund that is non-taxable. Are there any better ways to invest our money?
Well, those are tough questions. I mean, I run into friends of mine all the time where they come into a lump sum at a given time, Charlie and I do not have great answers about investing sums of money for people who are not really active in the process. I mean, as we said earlier, if we were working with small sums now, we would start looking at a whole bunch of very small situations and some things that we might know how to do on a small scale. But for the average investor who wants to own equities over a 20 or 30-year period, we think regular investment in some kind of very low-cost pool of money, which might well be an index fund, probably makes as much sense as anything. But it's important to keep the costs down. I have close to 100% of my net worth in Berkshire. I'm comfortable with it because I like the businesses we own. But I didn't buy it at this price either, so I don't like to go. I never recommend anybody buy or sell it. And Charlie, do you recommend anything?
I think if there's anybody in the room who thinks it would be very easy to come up with a one-liner for a great no-brainer investment tomorrow with a great slug of new money, I wish they'd come up and tell me what it is. We don't have any solution to that one. It's harder for us now than it has been at other times.
Yeah, there's been a couple of times. In 1974, there was something in Forbes, and 69, the reverse of that situation, and then I think I wrote an article for Forbes, I can't remember exactly when it was, about how equities almost had to be more attractive than bonds at that time, and bonds weren't that unattractive. I mean, every now and then you can say you are getting a great deal for your money in equities, or sometimes you can say you're getting a great deal for your money in fixed income investments. You can't say that now, so what do? in terms of new money, we find ourselves sitting and waiting for something, and we continue to look. But we are forced to look at bigger ideas. So if we were working with smaller funds, we'd be much more likely to find something than we are in our present situation. As Charlie says, we really don't have any great one-line advice on it. I wish we did. Zone 4, go ahead.
The real long-term rate of return from saving money and investing it has to go down from recent experience in America, particularly equity-related recent experience. The wealth of the world can't increase at the kind of rates that people are used to in the American equity markets, and the American equity markets can't hugely outperform the growth of the wealth of the world forever. We ought to have reduced expectations regarding the future generally.
Because, we mentioned earlier 53% of the world's stock market value is in the U.S. Well, if U.S. GDP grows at 4%, 5% a year with 1 or 2% inflation, which would be a very good result, I think it's very unlikely that corporate profits are going to grow at a greater rate than that. Corporate profits as a percent of GDP are on the high side already, and you can't constantly have corporate profits grow at a faster rate than GDP. And obviously, in the end, they'd be greater than GDP. And it's like somebody said that New York has more lawyers than people. I mean, there's certain, you run into certain conflicts in terminology as you go along if you say profits can get bigger than GDP. So if you really have a situation where the best you can hope for in corporate profit growth over the years is 4 or 5%, how can it be reasonable to think that equities, which are a capitalization of that corporate profits, can grow at 15% a year? I mean, it is nonsense, frankly. And people are not going to average 15% or anything like it in equities. And I would almost defy them to show me mathematically how it can be done in aggregate. I looked the other day at the Fortune 500. They earned $334 billion on it and had a market cap of $9.9 trillion at the end of the year, which would probably be at least $10.5 trillion now. Well, the only money investors are going to make in the long run are what the businesses make. I mean, there is nothing added. The government doesn't throw in anything. Nobody's adding to the pot. People are taking out from the pot in terms of frictional costs, investment management fees, brokerage commissions, and all of that. But the $334 million is all the investment earns. I mean, if you own a farm, what the farm produces is all you're going to get from the farm. If it produces, $50 an acre of net profit, you get $50 an acre of net profit. And there's nothing about it that transforms that in some miraculous form. If you own all of if you own all of the Fortune 500 now, if you owned 100% of us, you would be making $334 billion. And if you pay $10.5 trillion for that, that is not a great return on an investment. And then you say to yourself, can that double in 5 years? It can't, the $334 billion. It can't double in 5 years with GDP growing at 4% a year or some number like that. It would just produce things that are so out of whack in terms of experience in the American economy. It won't happen. So anytime you get involved in these things where if you trace out the mathematics of it, you bump into absurdities, then you better change expectations somewhat. Charlie?
Well, there are two great sayings. One is, if a thing can't go on forever, it will eventually stop. And the other I borrow from my friend Fred Stanback, who I think is here. People who expect perpetual growth in real wealth in a finite earth are either madmen or economists.